All right, all kidding aside, welcome everybody to the November 2016 Roundtable. The caption at the very top is Better Companies, Better Prices. Some of you that were in the Mid-Michigan Stock Pickers Breakfast audience saw this slide. I like it because it's got a lot of color on it and celebrates many of the things we do from up straight and parallel to our celebration of the various uh, aspects of literature from Better Investing and the National Association of Investors. Those trick-or-treater kids are back to remind us to think about small companies. We'll be covering that here tonight. But really, it is just a continuing celebration of coming together to identify opportunity and explore it together. With me tonight is Ken Kavula, president of the Mid-Michigan chapter and nationally sought-after speaker at a number of conferences nationwide. We're joined by our friend Cy Lynch, who is certainly taking off some time from his busy schedule in the theological world to join us here tonight. Welcome, Cy. And he intended to be with us, but again, Hugh McManus is just in a whirlwind of activity, and he really never knows whether he's going to be able to make it or not, just because of business commitments. But we miss him. We'll spend at least one slide. And again, my name is Mark Robertson, and founder and managing partner of Manifest Investing. If you have any request for slides or Q&A, and you're too bashful here to bring it up, again, we keep this fairly casual, and we'll be opening up the microphones through the program, and then we do have an extended Q&A at the end, but that is my email address there if you have a comment or a question. And again, as Ken said, if you want to be added to the reminder list, or if you have a friend that you want to get the reminder to, nkavula1@comcast.net. Let's go ahead and get the legal paperwork out of the way. No investment recommendation whatsoever is intended here. This is all a demonstration. It's basically to use educational purposes and for demonstration of the principles and philosophy of the modern investment club movement, be it NAIC or Better Investing. And again, everything here is for illustration. We may be talking about real companies in real time. We will be doing that. So again, do your own homework. Here's our standing agenda. Again, if you're new to this, welcome. Big hug for you. We basically do a very similar program every month where we wrap a few topics in along with some stock picks and very quick case studies. You'll see that Ken and Cy will be presenting CVS and Infosys tonight. And I couldn't believe we haven't actually added this one ever in the 6.5 years we've been doing this, Mercadolibre, which is the Latin American eBay. Ticker symbol MELI. We do have a poll at the end, so the audience does get to choose. Talk about a few coming attractions, and we'll be adding some to that here fairly soon. And then, like I said, Q&A at the end. Here's our reminder as to what we're here about. We are bringing ideas which rank among our best ideas at this time, and we try to pick out a single favorite opportunity. We do keep track of the results of the selections that we make. We'd like to see those beat the market by 5 percentage points, 500 basis points if you speak that language. And we use the Wilshire 5000 as our benchmark. We'd also like to see over half, roughly 2/3 of our picks outperform the total stock market after selection or after the time that the decision is made. We do have some fairly non-conventional selections that have been made from time to time. In fact, you're going to see Bank of America tonight is just going great guns, and it really has bolstered the portfolio, even though it was very tough to complete a stock study on that over the last 2 or 3 years. Hugh McManus never lets that get in the way, so it's actually worked out pretty well for him. Here's our overall performance. This is the scoreboard, the relative return since inception. Some people refer to relative return as excess return. It's the amount that the portfolio has beaten the performance of the benchmark, in this case the Wilshire 5000. You can see that our absolute return annualized since inception is approaching 12% at that 11.7 up here. Over half the picks have done pretty well. And again, that red dotted line represents our objective. We'd really like to beat the Wilshire 5000 by 5 percentage points over the long term. There have been a couple times we inched up towards it. We have kind of sagged off a little bit here lately, but we're not concerned. We see a portfolio that's actually well positioned for the future. There have been quite a few challenges to some of the stocks at the top. We were relieved to see Cognizant recover here in the last few days. pretty robustly and actually bumped that blue dot on the far right up from where it's sitting right there. Here's a look at the tracking portfolio. We use a manifest investing dashboard. That is a public link up at the top. If you just go manifestinvesting.com/dashboards/public/round-table, you can see, I believe there's about 111 positions that we're tracking over these last 6.5 years. And these are the top 20 in terms of size by percent of assets. So in the case of Cognizant Technology, I believe that one has been selected 12 times. Si's going to cheat tonight and select it again under the alias of Infosys Technology. We'll let him explain that when that comes around. But that does represent 5% of our selections. The 12,000 invested in Cognizant is now worth 17,187. That's what you see for the value. So again, these are the selections that have been made. I mean, in most cases, there's probably only a couple on this list that have been selected once, but most of these have been multiple time selections. And again, we encourage all investors, even with a tracking portfolio this size, to really keep your focus on three main characteristics of any portfolio, that being the overall return forecast. It's a weighted average. That 10.3 in the far right-hand corner is the weighted average return forecast for all the holdings in the tracking portfolio. The quality at 87.1 is excellent. Anything above 80 is in the top 20% of all companies. And we also like to see sufficient growth to carry the portfolio through all types of markets. We believe in all of the above investing, at better investing, and manifest investing. We'd love to see that average out to be about 11%, so we're a little bit light on the growth, but the quality and the return forecast are actually pretty strong, fairly sufficient. Any comments or questions on the most influential holdings from either Cy or Ken?
Well, I do think it's amazing, Mark, that we're putting a 10% return into the green, which means 5 points above the market. That means that the market is somewhere down around a 5% average return, when on average over the last 100 or so years, it's really been around a 10% return, and we've been shooting for around 15, 16% in our portfolios. So I think it just goes to show that the market's on fire right now, and it's more and more difficult to come up with a good stock to recommend to your stock club or to your spouse for addition to the IRA or to the after-tax portfolio, or however you manage your own money. And I think that when you say all the time, Mark, that there will be another recession, we just don't know when. I just think that sometimes we need to remind each other that at some point the market will go down again. It's not going to continue to go up forever.
That's right. I think another thing to remember is that should there be anybody here still looking at some sort of a fixed return goal, say to double your money in 5 years, the classic 15% a year, what you are doing, if you're shooting for that right now, you're going to be doing one of two things. You're either going to be shopping in likely damaged companies or speculative companies, or you're going to be stretching your projections, which the stretching your projections may not hurt you that badly if you're in quality companies, but trying to find a 15%er right now is so tough. I mean, like you were saying, Ken, it's tough to find good companies, you know, even in just the manifest green, if you will, that fit. But if you're shooting for 15%, you're probably stretching into speculative companies right at the time you should be seeking more secure, high quality, solid companies.
That's such a great That's such a great point. I mean, Nicholson gave stern reminders about be extremely careful as bull markets progress, not to chase speculative companies, you know, low quality companies, you know, basically trading in a peaking, high quality, excellent company and converting it into the other, because, you know, the high quality company, even in that recession when it hits, by the way, it'll be on a Tuesday at 3 p.m. I don't know what Tuesday. I don't know how much, but it will be. And again, the types of companies we're talking about around here, your Cognizants and those types, they're going to go down less percentage points than those other type of companies. And again, the numbers that we saw in 2007, 2008, 2009, the average high quality company went down like 20%, while the market average went down 40. But more significantly, very low quality companies went down an average of 70 or 80%, and that can wreck an investor. So size point is well taken, and that's exactly what Nicholson was warning about.
Mark, before you get off that slide, we had a question. Is there a reason for that red triangle next to Amazon? It's near the bottom of the list, or is that just something that was picked up and it's kind of like a piece of lint?
Well, it's an alert piece of lint. Actually, what that is, it's an alert that has been triggered. I believe I set an alert on Amazon in one of my dashboards. I wanted to be notified if the return forecast, the projected annual return or PAR, actually went back above 14. And lo and behold, it's at 14.9. So I actually got a reminder to go back and take a look, do a trust audit but verify type stock study of Amazon for some potential investment of Mark and Wendy real dollars. We're going to talk a little bit about alerts here in a minute, and we'll probably see a few more of those pieces of lint in future months. And
I'll reassure you, Mark, I really knew what the triangle meant, but I'm just using the Socratic method again. I can't get away from it.
I know it. Socrates wrestles me to the ground and beats me senseless on a regular basis, people. So it usually involves when I'm driving across the country with Ken. So here we go. One of the things we have been talking about over the last several months, and we're getting a little bit further along on our research in this, it's this notion of honoring the traditional time-honored guidelines for selling and managing portfolios. The same old rules that you've known all along. If the wheels start coming off because of a degradation in quality, if the return forecast drops low enough, and we think you have to look at that through two different prisms, depending on whether it's a core stock like Johnson & Johnson or a non-core stock like some of that we're about to talk about. And then we've talked about adding this relative return analysis or nudge or alert or trigger, and we'll take a look at what we mean by that for holdings within the first year. And let's go ahead and start off by just reinforcing.
Mark, before you scroll, can you go back to that one slide? I've got a lot of email about the fact that we're trying to change the whole way we sell stocks in Better Investing, and I want to just re-emphasize the fact that we're not.
We're not.
That quality degradation, that second point right there, that's the old something's wrong with the company reason for selling a stock. And that quality degradation could be, that can be a decrease in net profitability. It can be a decrease in the competitiveness of the company, the way its sales growth compares to peers, other companies within the industry. It can be a degradation of its balance sheet, carrying way more debt than it should, or having cash flow issues, or having inventory issues. So all those things about the company not doing as well as we expected it to do, that's covered in that because of quality degradation reason. And those are all the traditional reasons for selling. We're just adding a couple of more things to consider as we move towards selling a stock out of the portfolio.
And the one thing we don't do a lot of is rely on traditional zoning. That's probably a different conversation. But the relative return concept for a trigger or a nudge is new and we think it's complementary and additive. And again, we're still exploring and seeking that answer. So again, what Ken was saying, 95% of the stuff we're talking about, even for this portfolio, involves this notion of making the portfolio better. And that means taking a look at the portfolio. You can see here the number of repeat selections is on display. There's that link again, the public link. So you can actually see how many times stocks have been chosen, like Cognizant at 12 times up on the upper left, Apple 8 times. So you get a feel for how many times some of those companies were chosen. What we've done here is taken an excerpt of the dashboard and put on display by ascending order the PAR or the return forecast for the 5 lowest return forecasts in amongst those 111 positions. In the 5R night transportation, U.S. physical therapy that you can see there, Drillquip, PRA Group, which we've had a lot of fun with over the years, and Landauer, a stock that both Cy and I have featured a few times here at the roundtable. You can see that it's actually showed up 5 times. I think I selected it a couple of times, the audience once, and Cy a couple of times. So that $5,000 invested in Landauer is now worth approximately $5,000 after several years. It's actually had a pretty nice recovery here in the last few months. So you're looking at the lowest return expectations amongst those 111 tracking positions. Just as an example, you can see down at the bottom there, the top 3 listing the actual transaction date and the price that we paid for it, the current price that's as of yesterday's close, and then the value. So again, these are all 3 of these are one-time selections. So $1,000 invested has become what you see here for the value. So the annualized total return for the top 2 are 25 and 30%, beating the market by 13 and 19%, as you can see on the far right. Drillquip has not beaten the market. $1,000 invested in that is now worth less than $800. So it's literally down 18% compared to the market. So these are the ones, again, this notion of make the portfolio better by dispensing or discharging the companies with low return forecasts and replacing them with the stocks you're going to hear about tonight with higher return forecast expectations. So again, we don't need to do this out of desperation or any other reason. There's actually enough return in the portfolio at 10.3% when the average stock is at 5.2. Quality is fine, and like we said, growth. And again, you'll notice many of these, well, all of them are below the average growth. So if we can replace these companies with faster growing companies, we'll actually bolster that a little bit also. Anything jump off the page at you, Cy or Ken?
No, I'm perfectly happy to sell 4 out of the 5, Mark. I really think that we've made some mistakes in energy. We've held some of these through the worst of the energy downturn to $30 a barrel for oil. And I think energy might be trying to stabilize at this point. And I would be loath to sell something with as little risk attached to it as Drillquip has. At this point, it only represents 2/10 of the total of the portfolio, and I'd be willing to let it sit in the portfolio and see if we should make any kind of a turnaround in oil. But I'm perfectly willing to take the other 4 positive positions and freeze them out and replace them, like you said, with some faster growing companies.
And Cy, I think you had Landauer already on the chopping block. What are your thoughts on that one?
Well, I think Landauer has encountered some problems and is working on some restructuring plans. They've sold off a few divisions and have been struggling to find their core business to grow again for a couple of years now. And I can't see any real impetus. There's a word that's escaping me, but a growth driver that has driven the upswing in the last couple of months, unless it just is that people are buying that there's a turnaround, because the numbers are not huge. As you can see, the growth is still projected at about 2%. That's about half to 30% of what it was when you and I were picking it as a company. That looked interesting. And notice the PE that you're about ready, that you just put the mark under, a 4.2% and a 21 PE. I think that it's time to go ahead and take the money from this recent bounce. And, if the company does turn around, there's no reason not to go back and buy it again at another time. The other big thing that jumps out at me on Landauer is that 57 over in the quality side. Again, why should we be holding a company with, mediocre quality approaching just an average company when we're seeking to have excellent companies for a return of 3.4%? It doesn't make sense.
Yeah, one of those things on our list, Mark, was degradation of quality. You and I were looking at the quality graphs before the meeting started right here.
Here it is for Landauer.
Landauer was just a poster child for degradation of quality. Back when we were choosing it, quality, you know, at 90 or even close to 100, and today down less than 60.
Yeah, and this is kind of the point we want to make. You mentioned the lint on the screen. We're going to set limits on most, if not all, of the companies in, especially those that have, you know, concerns about quality. But again, we think it makes all the sense in the world when the quality drops like you see right here. At that point, to basically flag it and say, look, I'm going from a company that used to be in the 90s to heading for the 70s. You know, it's time to really take a look. And I can't help but notice that if we had made the decision to get out somewhere in this time frame, because there did seem to be quite a challenge, the stock is still not back to those levels some 3 years later. So this is just the type of example of, again, in my personal holdings, from my personal experience in investing, I would never accumulate more shares of a position like Landauer so long as this quality trend is so compromised. And until it begins to show strength, and as Cy just mentioned, I mean, they're not building any more nuclear plants. And I think there's one been sited in Georgia, in fact, but just one. And
right.
their endeavors into the field of medical radiation monitoring haven't panned out as well as they had hoped. I think they still could. But again, here's a situation of quality degrading, and maybe it's time to leave the dance. And I want us as a group to notice this point in time for the next stock that it happens to. So that's the type of limit that we'll be setting, and you'll see again pieces of lint showing up on the dashboard.
Yeah. And actually, Mark, that the chronicle and the line you drew, actually the current price is slightly above the line. It's actually at about a 3-year high.
Yeah, because it's come up.
It had that dramatic a jump in the last month.
Yeah, when Kurt files in November, it's actually going to be, the price bar is going to be back up at this line.
Right.
So basically, we've had dead money since November 2013. Exactly. It's just about back to where it was then. Yeah, Mark, we saw the same kind of degradation, not nearly as dramatic, but we saw it in PRA Group also, didn't we?
We did. You know, a company that was trucking along very high in the excellent quintile, and it has relaxed back not quite as dramatically. And by the way, we've seen more dramatic slides than even this one, but again, we think those two are candidates just on the lower return expectations and the degrading quality. Here's a quick look at one of the winners. And this is one of Ken's favorites. I think I brought this to the portfolio about 4 years ago. And a one-time selection, but you can see that it has been fairly up, straight, and parallel. I would argue that many aspects of the economy, at least a few, had their own mini recessions this year. And that is showing up a little bit in night transportation, a little bit of a bump. That accounts for the bump up in the PE down here, by the way. But it's maturing or whatever. It's a good company. We're not saying there's anything wrong with the company. It's an excellent company. The problem is Value Line has it at a long-term return forecast of about 1, and we're looking at about 2% with the price in the mid-30s. If you take a close look at the price chart, it's at all-time highs, and it's kind of up against resistance levels that, again, if it takes it out, who knows where it'll go. But in this case, I say we celebrate victory and take the money and run. So we see that from those top two positions, Knight and U.S. Physical Therapy. In fact, U.S. Physical Therapy has beaten the market by 19 percentage points per year since February 2013 when Ken nominated it. So every once in a while, it's okay to say, you know what, things look a little toppy. Why don't we just call it a victory, call it a win, and walk away? So we'll go ahead and...
I was so interested to hear about Knight, Mark. In my own investment club, we just met in committee. We have to come up with about $75,000 in January of 2017 to make a partial withdrawal for one of our partners. And we were looking at our portfolio, and we were putting some pretty heavy-duty SSGs together, and night came up on our SSG at actually a negative return going forward for the next 4 or 5 years, like negative 1.5%, negative 2%, something like that. So we're in complete agreement with the conclusions that you were reaching with the analyst numbers, and we're not going to forego night. We've owned night for years. We are going to put it on our pounce list. We feel it's one of the best run trucking companies in the industry, but right now we feel that we need to take our profit in the company and use it to pay off one of our members that needs a little bit of tax money.
So we'll go ahead and close out 4 out of the 5. Let's hold on to Dril-Quip. We think that the energy economy may be changing. If nothing else, the analyst or the rhino's perception of the energy economy is definitely changing. We could see with the next quarterly update in Dril-Quip, which will be early February, we could even see a slight shift in the fundamentals. Let's see what that looks like, and if it's still down here then maybe we make a different call, but let's let the perceptions of the energy economy bubble up and see what happens.
Gives us room for 3 or 4 other companies to come to the bottom too, doesn't it, Mark?
It does. And we'll continue to watch companies like this, and we'll get those alerts in place and see what we can learn. This last one, again, we don't want to spend a whole lot of time on this one other than to point out we want to be flagged or nudged when companies drop more than 20%. We're experimenting with what that number might actually be as a function of the quality of the company or perhaps the size of the company or whatever. But you can see there are about 10 positions that represented by only 4 companies, starting with Tractor Supply up to Novo Nordisk, that have triggered that 20% nudge at this point. And I guess my personal perception of most of these, including Polaris, even though Polaris might be the one which is most tentative, is these are still fairly high conviction situations. We're only in a few of these for a few months. I think Novo is a great long-term potential, and Proto Labs is another one that fits that bill. So I still think these are very high conviction opportunities. And before I turn over the microphone, the ones at the bottom are the ones that we celebrate just for comparison purposes. They're not all at minus 20, minus 30. Some of those are plus 40, plus 50, almost plus 60. The rather unconventional selection of Bank of America, when nobody liked it by you 9 months ago, is only up 50% more than the market. And of course, Cy gave us First Financial, which we actually did have SSG-enabled stock study along with it. Again, up more than 50% in the market. So all of those are kind of fun. And again, there's a lot of good news there. You notice that we did close out Nordstrom. That's the one with the only sale date on here a couple of months ago. Actually, just last month. Basically, again, taking the money and walking away, much like we're doing tonight with Knight and U.S. Physical Therapy. Any thoughts on or perceptions on this, guys?
Mark, I think it's really interesting. I think that we're beginning to form some opinions, and I just want to put that idea out there again, that I'm really thinking to myself that this number for the relative return discipline, I think that it's going to not only be dependent on the absolute value of the number, but I think it's going to be dependent a little bit on the rate of growth of the sales of the company. In other words, the size of the company as well. I'm willing to give some of these small companies a little bit more volatility than I am willing to give some of the really large, higher quality companies. So I'm very much in favor of us continuing this path and setting a few rules and then testing them for the next couple of years, see how they run.
All right, well, I show us at about into our first half hour, so let's go ahead and try to knock out 3 stock presentations and take it from there. So Ken has nominated CVS Health. Just as kind of a fun fact, Ken and I have done programs in Peoria and Indianapolis and Cincinnati here over the last month or so, and we share a number of screens as we're doing that. CVS showed up on many of them, including the triple play screen. So it's our selection for the November stock for our newsletter, and just quite an interesting story. Take it away, Ken.
Are you going to just move the slides, Mark? If you just hit, okay, just hit one then, okay. Well, I do want to go with my front slide.
I stuck your front slide right up at the upper top.
Okay, well, back up one notch then, can you? No, you didn't. Okay, that's okay. My front slide originally had CVS Pharmacy. And the point that I was going to make on the first slide was that a lot of you still think of CVS as a drugstore chain. And if you haven't studied the company in any depth in the last 3 years, then you've missed a complete transformation of a household name. And today the name of the company is CVS Health, because it has so many more components than it used to have. CVS is no longer just a chain of drugstores that sells pharmaceuticals to customers in the back and sells all kinds of sundries in the front of the store. CVS is now a PBM, that means a pharmacy benefit manager, so it provides drugs for many people on different drug plans, whether they're associated with their insurance policy or whether associated with Medicare policies. CVS does a lot of PBM management, pharmacy benefit management. CVS now runs a company that used to be independent called Omnicare, which basically provides drugs and services to nursing homes and to residential facilities. CVS now operates the Target pharmacies in all of the Target stores, and their contract calls for them to operate the pharmacy in all the new Target stores as well. So CVS has really changed an awful lot in the last 3 or 4 years, and there have been a few hiccups along the way. You could see a hiccup in the second quarter of 2016 fiscal year right there on the graph. That open dot kind of moves down. But you can see a recovery in the earnings back up in the right direction again, and sales, meanwhile, have been moving in the right direction for quite a while. Mark likes to remind us, and I like to remind people based on what he says all the time, is that you have to be real careful with these kind of pictures, because this company has changed so much that we're not looking at one continuous company, but rather we're looking at a lot of different companies at different points in time, so much so that Morningstar and Value Line, and I'm not sure if S&P has or not yet, but they've even reclassified this company into a different industry group. When you go in and look for Walgreens, the old reliable competitor to CVS, you'll find that in some of the classification systems, CVS is no longer in the same industry even as Walgreens, even though they do compete in the drugstore part of the business. I'm looking at historical sales numbers, and I did a pretty traditional SSG to start with. If you click once, Mark. And to put my SSG together, I always go to Value Line as one of my first sources. The Value Line that I'm reading for CVS happens to be dated in early first couple of weeks of September, and at that point CVS was selling at a price of around $93. I've circled it on the corner of the Value Line page there with a low total return forecast of around 11%. I've circled it there as well. Today CVS is selling somewhere in the low to mid 70s, which would mean that projected return probably is up closer to 15 or 16%. I really got interested in this because I know that what Cy told us earlier today is something that's absolutely true. Finding a good, consistently growing company that's going to return you maybe 13, 14, 15, 16% is very difficult in today's world. I'm looking at earnings growth from Value Line's estimate, at least, of around 12%. The analyst community is a little bit more aggressive in that call. Sales growth of around 11%, and that's pretty spot on in the analyst community as well. You can see some of the numbers up near the top that come off of a traditional SSG. Pretty consistent profit margins from the 2015 number to the 5-year average. Return on equity that has moved up a little bit, and I would expect that tick up in return on equity because debt has also moved up, and I know that those two numbers are closely aligned with each other. CVS is aggressively paying down this debt. This debt has to do with acquisition, specifically the Omnicare acquisition, and CVS would like its debt, it's stated on its web pages even, it would like to bring its debt to capital down to around 20, where it traditionally has sat for the last 7 or 8 or 9 years if you read the numbers. If you click again, Mark. I don't too often read a paragraph on Value Line that's as optimistic as this paragraph. Now, granted, it's dated September 16th. That means a new one's going to be coming out in a couple of weeks for me to take a look at. But I would pay you to read the Value Line page, the whole thing. This is just a capture of the very last paragraph where they don't find much not to like, short-term or long-term, about what's going on with CVS. They acknowledge some of the challenges. They acknowledge some of the numbers are not where they need to be. But all in all, they find this to be a very strong 3 to 5 year future investment. My traditional SSG gives me a par value of around 15%. I circled it up there in the upper right-hand corner. And there's a Morningstar report for CVS, which is just full of information. I would suggest especially reading the valuation section of the Morningstar report. You'll get a really good picture of where that particular analyst think that this company is going as well. Click again, Mark. Here's the Eagle. This is the manifest investing stock selection for CVS, and I've circled 3 numbers which I'm going to put to the test with my own research. The analyst community seems to think that sales should be somewhere around 9%. And I took a look at the analyst community and I came up with a number slightly higher. I think that the community is basically up around 10.5%, 11%. So as I move forward, I'm going to change that sales number. I'm looking at the net margins and I wanted to kind of stick their feet to the fire. So I reduced net margins from the number that Mark has, which is, I think it's 3.5, isn't it? 3.8. Okay, and I reduced those net margins a little bit, and I also reduced the PE forecast. I'm thinking more in the line of an average PE of around 14. And if you click again, well, first of all, notice that these numbers coming from the analyst community are giving us a 19% par value. Click again, my adjustments, and I've adjusted to 11 and to 3.5 net margins and to PE of 14, and notice that I'm down around 16.8. That's awful close to that 15 something that I had on the traditional SSG. I'm feeling very validated. I'm feeling very comfortable. Frankly, I think that all of the numbers, the 19 that came from the analyst community, the 16 that came from my adjusted, the 15 that comes from the traditional SSG, I'm thinking they're all in the same ballpark. So I'm feeling pretty good about CVS. The last place I look, and one more click, Mark, is at the same diagram we were kind of checking out before. And I'm kind of looking at the quality line to start with. And, that's really monotonous for the last 2 or 3 years, monotonous up near 100. You can't really get much better than that. So I'm not seeing any degradation of quality at all. I'm looking at the par value in the most recent month that's on there. That's October. That's the most recent month on there. Par is above 15%. I'm still looking at par at 15, 16, 17, and that's a historic last 5 years, last 4.5 year maybe, high number, and that's the kind of investment that I like to make. I really like to invest in a stock with consistently high quality, a historically high par value going forward, and I think that when it's all said and done, I have the potential to to make some money. So I'm going to add CVS to the portfolio this evening, and that's a repeat pick. It's not the first time we've added CVS.
Yeah, in fact, I'll take credit for adding CVS 4 years ago at a stock price of 34. So not too shabby. Some good stuff there. Oh, and
Mark,
go ahead.
We have a hand in the air from Cynthia, and Cynthia, I'm going to unmute you. Go ahead with your question. Cynthia? You seem to be muted at your end, Cynthia. Okay, we must have an inadvertent hand, so I'm going to take the hand down. And Mark, you can continue with your comments. Go on, Mark.
Okay. Just a quick point that a lot of times when you see us put out a chart like this, side by side, those two columns, you're basically talking about the date of the value line report, which, as Ken pointed out, was 2.5 months ago and $20 ago. So side by side, you can actually compare them, and certainly would concur, and we're featuring the company also. So,
Mark, I'm going to answer a few questions real quickly. Joe wants to know, what's the screen grab software that we use to pull the pieces off? We use a piece of software from a company called TechSmith. They're located right here in Michigan, and Mark and I both use that piece of software. Cy, do you use Snagit as well?
I do as well, yes.
Yeah, so Joe, Google Snagit, S-N-A-G-I-T, and I think that'll take you to the TechSmith site. He also wants to know, where do we find that eagle that we were just looking at? Mark, can you show Joe exactly where you're finding that eagle?
Sure. We can go ahead and jump out of here for a second. Switch into any stock. In this case, we'll go to CVS. Well, let me do it this way. At Manifest Investing, again, if you're not a subscriber, send me a note. We'd be happy to give you a free test drive. But what we're talking about here is going into research for companies. We're running a tiny bit slow here. I'm battling with my cable modem. It's not the site's fault, it's the cable modem's fault. And in fact, I need to come down here to my studies. And again, we can enter a ticker symbol here, and that will pull up what Ken had on his screen. Basically the eagle. Let me see if I can shrink that a bit to get it all on the screen. And what is done here is basically we jump out and grab some publicly available data as far as the growth rates and things that you saw Ken circling. And any box that has a little triangle in it, you can adjust, as you saw Ken or heard Ken do, switching the sales growth to 11%, for example. It allows you to do a bit of a sensitivity analysis to see how changing anything along here will affect the bottom line outcome, which is the return forecast. So again, you go to the Manifest main page, go to research. Under research, go into my studies. Think of it as a case study library. Anything else, Ken?
Well, I have a number of comments from a number of people that want to know about CVS and competition, and CVS and their business model, and loss of some military business, and everything else. And I'm saying this with a big smile on my face, folks. I think sometimes our intuition, our instincts in better investing are to just find somebody that knows a little bit about something and then just push it for all it's worth. I would urge you to get these questions that you have answered by going to the standard sources and starting by doing some reading. Go to the CVS website, look for some investor presentations that are there. If you're really interested in this company, I did that. I did a lot of the research. I will tell you that I read everything about the competition that some of you are speaking of. I made note of that in the presentation. And I will tell you that the final decision on whether you think the company is going to continue to move in an upward direction and make you some money has to be up to you. I can't change your mind as to whether or not you should invest. And in fact, that's not the purpose of this demonstration that we do. The demonstration is to give you a little bit of education and give you the tools to become a better analyst yourself. So I would urge you to move to the value line sheet. A new one's coming out in 2 weeks. Move to the Morningstar report. The Value Line site has a lot of new information about CVS on the Value Line site that's not part of the PDF document. You might want to read some of that. And I found the S&P report to be enlightening as well. So take the time and go and read those things and see where you come down as far as this competition and as far as the forward-looking ideas for the company.
Yeah, and for some of you that may be relatively new to this whole notion of analyzing a company, I thank God every day for George Nicholson, and there's a reason that those 3 pictures are in front of you, and the reason is because Nicholson taught us that what you really want to wrap your arms around as you attempt to study and understand any company is how will they grow. That's that red dotted trend line through the revenues up at the top. That's, you can argue the number 9, 10, or 11%. It's something like 10. And the second thing he said is pay attention to the profitability. And as you look down over here, I don't care what the numbers are. This is a company that basically bounces around a tiny bit. Keep in mind that this is a fairly tight scale here. So, 3.5 plus or minus 0.2% or so fits this company. And there's your picture. What is the PE doing? Well, it seems to be getting more respect. So it's been gradually ramping up from 10, 11, 12 to the mid to high teens. And you can actually wrap your arms around those 3 things: the sales growth expectations, the profitability expectations, and the PE or the valuation expectations. Those 3 things are what basically generate a return forecast for any company. So when Ken is saying, do your homework, go to those various sources, he's basically saying, look for things that support your findings in those 3 areas. And then I would take it a step further and then basically identify the threats, or even better yet, the opportunities associated with any of those 3. And that's where investing gets to be really fun, and it's not that cumbersome. So I'll get down off the soapbox now, and we'll switch to Mercadolibre if we're okay to move forward, Ken.
Absolutely. We have some questions, but folks, we will try to answer every single question before we get off of the webinar this evening. So if we don't get to yours immediately, please be patient.
Okay, Mercadolibre, it's a company that we have actually kicked around a number of times at some of our regional conferences. I'm stunned that it's not in the roundtable tracking portfolio. It's been a part of our 10-cup model portfolio from time to time. You see a picture here that is almost up straight and parallel. You can see that there was tremendous price volatility back in 2008, 2009 during the Great Recession, as represented by the size of these bars on the left-hand side. But again, we're talking about a relatively small company, the Latin American eBay, if you want to think of it that way. So you're looking at an early stage eBay. You can see that profitability, without looking at anything else, has been flattening off a little bit, but nothing to be terribly concerned about. This is a ripe field of opportunity, and with some of the events going on in Latin America, I think for the very long term could be a real potential opportunity for us to take a look at. The stock price has been on a pretty good run of late, but it still hasn't recovered all of what it was back in the past. Perhaps the thing that really gets me with this company is we're talking about a level of profitability which could very easily expand to resemble eBay. And again, just like Ken was saying, do your own homework. Go take a look at the profitability of eBay as it became mature. And it all revolves around this notion of a scalable company. In other words, they can add customers without a whole lot of fixed costs. So basically, as more customers and more things are sold, they can do it without incurring a whole lot of cost profile. Therefore, their profitability could literally go from current day levels of, let's say, 15 up to 20, 25, even 30%. And that's an incredibly high potential situation for a company when you find it. I found this one by taking a look at the best small companies. that we kick around every year around Halloween. What is really exciting, we're bragging a little bit here. Since Halloween, that's only 3 weeks ago, folks, 4 weeks ago, I guess now, the Wilshire 5000 is up about 4.5%. If you take a look at the 40 best small companies that many of you are familiar with that we've kicked around, we'll be putting out that feature in the public arena here in the next couple of days. That set of 40 stocks is up 10% in, again, just 4 weeks, and we like that. So this is an example of one of those companies that can be particularly rewarding. We have a public dashboard for the 40 companies. I have sorted that dashboard from top to bottom based on the highest return forecast or the highest par. That's what you see over here on the right. This is just flat out cool. There's still some companies that represent pretty decent buying opportunities. The value column, again, is that $100 invested on Halloween. Again, 4 weeks ago is now worth, in the case of Intelliquent, a stock that has been a part of the roundtable in the past, Intelliquent is up 36% in 4 weeks. So not all companies have taken off and gone like that. But again, you see very high quality companies. You can have high quality companies with relatively consistent earnings, even though they're small. We've talked about this for years. And what I basically was looking for is companies that still have a relatively high return forecast. In the case of Mercadolibre, 19%, that also have exceptionally high quality. It fits the bill. It's down about $3 here in the last 4 weeks while everything has gone up 4%. I like that. I think it feels like opportunity. Going down this slide, Universal Display is a multiple time selection for the roundtable, as is Proto Labs. Caesar Stone, which has hit a speed bump, possibly representing opportunity. That's up to you. Mesa Labs, a company that's been presented a number of times and is doing quite well for us, is on this list, along with a couple others, including Meridian Bioscience, a good study, ticker symbol VIVO down at the bottom. And again, these type of companies have been so rewarding. The last couple of years, the returns have been between 20 and 25% from the small company list. We think they're well positioned for this year. And again, it's part of that January effect. This time of year, we think it's an excellent time to go looking for. Some of these companies are actually impacted by tax-related selling, and which depresses their stock prices during October, November, and December. It appears that they're already taking off, so we have to, again, as I've suggested in some of our writings, the January effect is now the October or November effect. So some of it has left the dock or the train station a little bit. Again, here's a look at the stuff.
Mark,
yes, Ken.
Excuse me. We should make it clear to the audience that that best small companies list no longer belongs to Forbes magazine. They stopped publishing that list 2 years ago, and for the last 2 years, Mark has done the lion's share of the work coming up with our version of the best small companies. I think our list is a little bit shorter, maybe only 40 or 50, but it certainly exhibits a set of companies that will give you a nice number of good ideas to study for the next year. And since Forbes no longer wants to give us that kind of a list to deal with, we're just kind of stepping into the void.
Mm-hmm. And we'll be putting out a little bit more literature on it. But for those of you that are subscribers, if you go to more dashboards and right down here where it says best small companies, that will give you the 40 companies. And again, Intelliquent, Synchronous, Grand Canyon Education, they're up more than 30% in the last 4 weeks. And this is the complete list, can sort it by quality if you want, highest quality, and hunt among those. That's a good place to be hunting. If you're not a Manifest Investing subscriber, you can still reach it by Best Small Companies 2016. Excuse me, it's Best Small 2016, as you can see right up here up at the top. Best Small 2016. So these are the picks for between now and Halloween 2017. So again, you can get to that under our published dashboards under more. It's currently the 4th one down. You can kind of play around and take a look at some of those opportunities. All right, so here's a look at Mercadolibre, again, using the stuff that Nicholson taught us is so important. Mercadolibre in the last year or so has become part of the Value Line standard edition in their coverage. And Value Line is a little bit pessimistic. A lot of times with early stage or unusual companies, they can be that way. Again, a fairly up straight and parallel situation. It's been kind of in the doldrums for a few years. Again, the global recession has something to do with that. But you're talking about a company in the 20% sales growth forecast range. Again, we're under $1 billion in sales here with admirable margins of 17 to 18% on average. But take a look at this graphic. And again, as I suggested earlier, go back and see, what is possible if these guys really do hit on all cylinders, and you'll find that this black line might not be science fiction. So there could actually be incrementally better expectations from something like that. High PE company, again, early stage, less than $1 billion in sales with a 20% growth rate. So these PEs are not that unusual, and they will mature over time, but it would not be unreasonable to expect a PE in the 30 to 35 range, even 5 years out for a company like this. Under these conditions, you are looking at elevated returns, elevated rewards for the risk taken. And anytime I see a company like this that offers a 15 to 20% considered achievable return, it's compelling. So I look at it and I see a fairly compelling situation from this company. You can see it's down about $20 since 2 weeks before Halloween. So I'm going to add Mercadolibre to the roundtable tracking portfolio and hope for the best. It certainly will bolster the tracking portfolio overall growth rate. All right, so with that, we're going to turn to the information technology side of the world. And let Cy take us away with Infosys Technology, which is just a stand-in for Cognizant. I'm telling you, people. Go ahead, Cy.
All right, thanks, Mark. I'll keep it real short and sweet since this is just a Cognizant in disguise, according to Mark. I figured that with 12 picks or whatever it was enough on Cognizant.
You just didn't want to do 13, did you?
That's right. Unlucky 13. Exactly. Another reason, though, that I like Infosys this month is I have a choir director that always highlights how we pronounce words and emphasize words, and he always talks about putting the emphasis on the right syllable. And emphasis, if you play around, emphasis, emphasis, it's a different spelling of the word emphasis, but it's close. So you can see nice up, straight, and parallel is why it's attractive to us, and it's a relatively well-known company in our community. Let's go to the next slide, Mark. Again, where I got it other than Cognizant in disguise, I've explored a couple of potential new companies for this month, but decided that I think Ken in past months has kind of encouraged us to look some, and in fact he did with CVS, a company that perhaps has not been picked a whole lot in the past that we is in the portfolio. We just closed out the position in a couple that had done well but had only been picked once, and so perhaps we could have made even more money in those by repeating it. And so I just ranked the portfolio by value, going in reverse from the smallest holding increasing, and you could see all of these are pretty much one-time selections. I then just skimmed over or moved my eyes over to the last two columns, quality and par, and just started looking for excellent, that means blue quality companies that had green or potentially yellow total return. And then just really to get down to Infosys was more or less my gut on a couple of things. I did do some study into Mednax that you see on this list that is high quality and a green return, and decided not to go with it. and I'm trying to see if there was any other that I looked at extensively. I don't think so. I think that's the one that I looked closest at. And then since I pretty much knew Infosys was Cognizant in disguise, I said, we'll go with that. So that's where I came up with it. But again, I always like to double check and make sure there's not something better out there in the universe to invest in. So next slide, Mark. I just did a quick stock search, basically plugging in Infosys's numbers. I went ahead and dropped the par that I screened at down to roughly my par plus 5. I rounded down to the 10%. It was at 10.1. I decided to tighten quality 90. Could have done 99, but there's not that much difference between a 90 quality company and 99. So I thought 90 was a good high quality threshold to set. Again, in this particular market, I like the 90 financial strength. And again, you see Infosys is at 94. So that's roughly what they were. And since it has a yield of about 2%, a little over 2, I stuck in a 2% yield. So what I'm doing here is I'm looking for other companies with similar quality and return characteristics, and you see what comes out. Meridian Bioscience, Mark just briefly mentioned earlier. AbbVie is still a little new to me to make great projections on, but that's certainly a company that might be worth studying based on this. Polaris is in the portfolio, as is Amgen, Apple as well. And so I was content that Infosys is for the quality, and the other return characteristics was the best for what I was looking at. Next slide. So for those of you who are not familiar with it, it is a global information technology provider. It outsources IT operations for companies and advises them on software and other technology operations in the company. It's actually kind of the opposite, or the mirror image perhaps, of Cognizant. Cognizant is a company that has significant operations and employment operations in India, yet is headquartered in the United States. Infosys is a company that has significant business operations in the United States, again with much backroom in India, but is headquartered in India, so it's actually traded as an ADR. But they are very similar in their business model, in that they are IT outsourcers with significant backroom operations in India. Their historical focus is on the banking industry, and we'll see how that impacts the opportunity reward perhaps. And then notice that they have a wide range of services pretty much all along the software cycle. They consult with the client, as well as design, develop, and maintain, and all of that sort of thing, the software. Next slide. The reason that Infosys has some potential at this point in time, perhaps outsized potential, besides the fact that I think that this whole outsourcing of IT still has great growth potential. It's why I like Cognizant as much as I do. I think that the companies and the industry have good potential, but both, well, pretty much all of the companies in the industry have been beaten up somewhat in the election, particularly the first week after the election were hit hard. They've bounced back significantly in the last week, but largely because of immigration related concerns, the HB1 visas, and whether or not the new administration might restrict that, as there has been some talk about. Morningstar, in their last report for Infosys, I'd encourage you to read, as Ken did, and they address that issue. And I think there's some good analysis that you can get there, as well as just some general lessons for potential overreaction and trusting management that you can get out of there as well. Other concerns that have pressured Infosys's stock price a bit lately is concern over softening demand in the financial services sector. Remember, that's where their historical core operations are. They also have about 25% of their operations or their revenues coming from Britain and the European Union, so there's some concerns over the Brexit impacts. And also, and this is more of a company-related concern, but management is trying to address, they have a pretty high employee attrition rate right now, particularly at the leadership level, and we're talking about mid-level management leadership level, and they're trying to get that under control, which will help reduce some of their labor training and related expenses, and perhaps help the profit margin. And here are my judgments going forward. They're pretty much in line with the analyst consensus at Manifest. I'm a little lower on the sales growth. I think it's about 8.5% or so, the consensus, but we're right in line with an 8% going forward. Net margin is about flat. Again, it's been trending down a little bit. Most analysts think that it will reverse and come back up. I'm leaving it about the same going forward. And then a PE forecast, which is based pretty much on the median for the last 5 years, is where I got the 17.5%, which again, the growth rates and so forth have been about the same in the last 5 years. So I thought that the PE right now has been knocked down a bit because of some of those concerns that I just mentioned, but I think can certainly come back up. And that gives me a projected return of 12.4%, and why I'm adding or accumulating another 1,000 in Infosys this month.
Well, that's another second time addition to the portfolio. Again, I think I brought that one about 4 years ago also.
Cy, we have an interesting question from Cheryl. She says that she knows that Cognizant is experiencing some legal problems in India with some bribery scandals. They've taken quick action to get rid of the people involved. Is Infosys experiencing any of the same kind of problems that you know of?
Not that I am aware of. I would suspect if they're a wise management, they've taken a look at it, and unlike Cognizant that did discover the problems and took action, apparently, let's hope they have not discovered any problems and did not. But I'm unaware of any similar problems.
Thank you.
All right. Well, while you're cranking up the poll, Ken, we can take a quick look in honor of Mr. McManus. I really got a kick out of this month's 52-week low. We call it the proximity screen. He likes to look for companies that are in his vetted list that are trading fairly close to their 52-week lows, and it's kind of fun to try to guess what he may have chosen. I have a feeling he likes a couple of those names at the top of the chart, from Novartis to he has mentioned Nike in the past, of course, Eli Lilly, but that's a pretty good shopping list too. Notice that with its price challenges, Novo Nordisk is also on this list, getting fairly close to its low. But a lot of healthcare names. Notice that Infosys is on here also. So you're basically buying it potentially at support or definitely at discounted levels versus its recent price range. But from top to bottom, I didn't make any extra effort to limit this to health care companies and just look at them all popping up. And just kind of an interesting list to do some shopping also.
Hey, Mark, here comes our poll. When it comes up, folks, please make a choice or choose none of the above. I'm going to launch the poll.
And I'm not trying to persuade the audience. I really think that all three selections tonight have pretty decent outlook.
We're up to 83% voting already, 87%. Let's see if we can get above 90% tonight voting. There we go, 90% plus have voted, so I'm going to close the poll and I'm going to reveal the results.
Oh my
Jesus,
goodness.
And,
got out of single digits.
and it looks like we have 63% that want to add CVS, and 8% would like to add Infosys, and 23% would like to add Mercadolibre as a second position. So we'll add another position in CVS. And we'll all cross our fingers and hope it does fairly well. Okay?
You know, would I have a better chance if we went to like an electoral college system, or?
You might want to change your name and make it start with a tra and end in a mump, you know, and see. I don't know.
No, you guys are bad. All right, so we'll go ahead and add a couple of CVS positions and also incorporate the selections made by Mark and Cy also. Just a quick note.
I second Roy's motion for a recount.
You want to go electoral? We'll put together some type of proposal before one of the next few meetings to see what we can do. Well, thanks, everybody.
Mark, you want to clear some of these questions off the questions log here? Let me ask a few of them, okay, and feel free to take any of them. Herb would like to know, since Infosys is an ADR, is it a problem for clubs to own it?
It should not be. The only odd potentially accounting issue with ADRs that I'm aware of, and right now I can't think how you would put it into the club accounting, but I don't think it should be a problem. It would just be a cost entry. Is there is a fee involved in it. It's charged by the ADR holder, the manager. That at least Schwab, and I don't know about other brokerages, has been passing through to the shareholder in the last year. So it's kind of a negative. Where it comes out is and I guess that's how you would account for it. It reduces your dividend. It's just a fee. And of course, there's dividend reinvestment fees that club accounting can handle and so forth. So I don't know why an ADR should cause any problem.
Yeah, the only other tricky thing, Cy, is that sometimes an ADR, if it pays a dividend, will have some foreign tax withheld.
Yes.
But again, that's accounted for in your club accounting with no problems whatsoever.
Right.
My club holds a couple of ADRs, and it causes us no problems of any kind. Let's see. Mary would like to know, if a company's quality changes, how would you think about Wells Fargo, which has had 2 bad news events recently, but none of them are showing up in the quality as of yet? Mark, you want to take that one?
It's an interesting thought. Again, you have to put it in the context of we're pretty unemotional about the quality of a company. In the case of Wells Fargo, let's go ahead and pull it up. The stuff that builds that quality rating would be a growth rate, the profitability of the company, the strength of the balance sheet, all of those things. And until those things start to deteriorate, either in the perception of the analyst, sometimes that takes some time. You know, if, for example, there is a fairly widespread migration from Wells Fargo, again, I don't remember the statistic, but I think the stat is 1 out of every 3 households has at least one account or something like that. So, I mean, this is a very pervasive company. If that begins to erode or change, then yeah, the quality will reflect that as soon as the analysts believe that there is any downward drift in the fundamentals. I don't think there's been time yet to really see much of anything. Looks like the return forecast has deflected a little bit, but again, from respect to quality, none of the pillars of quality or the components of quality have actually seen a change. I have not seen a change in financial strength rating or any of the debt ratings or anything like that yet. Growth expectations. So you really need for those things to be happening in order to deflect the quality.
We have a question from Jane. Jane's hand is up. Jane, you're unmuted. Go ahead and ask your question. Jane Donvito, you have your hand up? Her hand went down with no question, so I'm going to assume it was an inadvertent hand. And if you give me just a second to get back to the question screen, okay. I'll ask another one here.
I would add one thing to the Wells Fargo question, Ken, and this goes back to Arthur Andersen and, other stuff that has happened. I'm not saying that it's even close to a scale of what Arthur Andersen went through, but when the consumer and the investors lose trust in a company, they lose all faith in a company. In fact, I was quoted as saying the future PE is 0. And when that happens, that's a completely different story. If the projected PE for a company goes to 0, it has obvious results for those of us who invest. So that's another place that it will show up in the PE expectations. I don't think Wells Fargo qualifies for that type of consideration or treatment.
Okay, Mark Don would like to know, are you going to be posting a book review on Dr. Chugin's from AAII, his level 3 book? Clunan. Boy, am I reading that lousy. On his book, his level 3 book, are you going to be putting a book review up?
We are going to be doing that. I'm going to reach out to a few people that have actually said they went and got the book. Obviously, we've got Christmas coming up, so we may let that slide into early to late January, but I am finding enough. I'm about a third of the way into it. It's pretty much what I expected so far. He very boldly aligns with a lot of the stuff we believe about modern portfolio theory and that kind of stuff. So it's gonna be. Cy, you would love it. Remember, we did the thing about Buffett,
yes,
efficient market vampire slayer. I mean, the book contains that type of rebellion against certain dogmas and stuff that is done every day in the financial planning and investment advisory universe. So it definitely is. It's definitely provocative, and I would target again with Christmas coming. I would say mid to late January for a couple of book review sessions because I do think it's worthwhile. The name of the book is Investing at Level 3. It's by the founder of the American Association of Investors, James Clunan. That's Cloonan. There's already a fairly lengthy thread on the Manifest Investing Forum if you want to catch up with some of the stuff. We have not begun dissecting it piece by piece yet, but it's definitely worthy. And basically to boil this all down and translate it, I think it's going to align with George Nicholson's manual for the individual investor fairly well, with possibly some interesting caveats or reinforcements.
Yeah, I think some of the excerpts I've seen, he really hits hard the whole volatility is risk.
Oh, big time.
Mark, we're getting some good comments from our friend Marianne in Ohio. She says it's a great book and she'd love to maybe have it be part of a Saturday morning event. So you might put that in your back pocket and think about it for a little bit of time.
Yeah, we are going to have that posted for this Saturday morning. We'll talk about a number of things, maybe some of the 35,000 feet perceptions of this book.
Okay. Stephen evidently was fascinated with your Infosys argument, and he's asking you, why is phonetical spelled with a PH?
Can I phone
that's,
around?
He's going. I don't know, but it's just an aside that I found amusing here. Judith would like to know: doesn't the dropping in price of CVS for the past year or more bother me? And Judith since I added it to the portfolio after doing a significant amount of research, I will disclose that I also own it myself in a couple of portfolios. I haven't been pushed into selling it, and no, the price drop doesn't bother me. I think that it's been the whole healthcare sector, I think, has been under a kind of a cloud with all the political talk back and forth, and I don't think we've resolved any of the issues about what's going to be happening with healthcare going forward. But I still think CVS is a very strong business. I did read about the competition, but I also read about the competition, the different places that CVS is building a market. So I'm still comfortable with recommending the stock, and I'm still holding it myself. Joe says that long-term Tractor Supply, and that was one of the ones on one of our lists, Mark.
Mm-hmm.
Long-term Tractor Supply, he says he has a relative value that's about 10%, and I'm thinking that there's a difference between, I'm sorry, he said relative return, but I'm thinking that maybe Joe is asking us how we calculate relative return. Can you go over that real quickly, Mark?
Yeah, in the case of Tractor Supply, let me see if I can jump back to the screen that it was on. In the case of Tractor Supply here, the stock has actually gone down. It's been held for much less than a year. It's actually about 4 months. It's actually declined 17.6% during a period when the market has gained 3%. So the difference between those two numbers is 20.6 on here. So again, the market's gone up 3% in the last 4 months, and Tractor Supply's gone down 17.6. So the difference between those two numbers is 20.6. See if that helps.
Okay, we'll see if Joe gives us another question here.
Keep in mind that we track the performance of the Wilshire 5000 from that purchase date until today also to come up with that relative return number. I just can't put too much on one screen.
Well, and Joe is making the point that that's very short term, and Joe, that's exactly the point that we're making with this selling trigger on relative return. We've noticed that stocks that have a huge difference in relative return during the first year of ownership, that we might be able to preserve our capital and then come back for a second try at a more opportune moment if we choose to. And that's the exact thing that we're exploring right now with these triggers. It is going to be a short-term trigger, less than a year. Mark, anything to add to that comment?
Yeah, for those of you in the audience who want to take a closer look at this concept and understand it and what's driving us, because I think that is important. If you go to expectingalpha.com, that's our free blog. It's absolutely free, and it'll take you to an article called Relatively Better Selling. It's also one that we published to our subscribers, but it actually walks you through and describes why do we care about this. And what it really revolves around is we believe, after taking a look at a couple of portfolios with over 10 years of history, that if we had stopped out of some of these companies where the wheels came off, and the one that we use as an example is my fabulous pick of Iconics brand, where I believe we bought it around 100, it dropped down to 80, and if we had done this and basically called it timeout and walked away at 80, we would have avoided going from 80 down to 30. And what we did is we found that there were a fairly low number, but a decent number of opportunities to do this timeout or step aside type approach. And the end result was an additional couple percentage points of performance for the portfolios that we looked at, and that is enough for us to really get our attention because of this chart. Every time you can make a couple percentage point moves up this chart, you greatly magnify long-term returns, and that's what we're after here. We're after every percent that we can get our white knuckles on, and if that relative return timeout concept can give us a couple more percent, we're all for it, and that's why we're studying it.
Mark, Marianne would like to know, how do you take part in the Saturday morning open mic that you referred to?
Well, there'll be an event posted either tonight or tomorrow at Manifest Investing. You can send me an email if you're not a subscriber, markr@manifestinvesting.com, and be happy to send you a link to it. It's free. And what we basically do is just talk about things that all of you guys want to talk about. I'll have a couple of things to talk about, certainly not limited to the fact that we're at all-time highs in all of the major industrial averages.
We're getting a couple of questions asking us to what we think if something will go to a certain price, and you know, if we had the answers to those kind of questions, I'm not sure we'd be doing roundtables once a month. What do you think, Si? You know?
I think you are right. And in fact, the other thing that came to mind was that maybe why I went to seminary for 3 years is and if I could get a little help in that regard.
We're hoping for that connection to come through for us, Si.
Yeah, Marianne is telling us that she also owns CVS. It lost Medicare approval a few years ago for some of its customers and then doubled in price. She sold Walgreens when it lost Express Scripts. That was a big mistake. And she says that drug companies continually are making deals later and they come out fine, that she thinks that CVS is a buying opportunity. So that's just one person's opinion. Let's see. Anne would like to know, with recent election of what is this
Careful, watch your language now.
With recent election of additional approach, do we have any ideas about cannabis going forward? And there's an embarrassing silence on the other end of the microphone here.
That is definitely an area of very intense speculation. There are some people investing, I'm talking about private equity now, investing a lot of money in it. And I think it's a perfect example of casting your whims on what a government may or may not do. And Ken taught me a lot about what a government can do to a particular industry just because they feel like it with educational services. So I would just, if you do go into that, go into it with all the caution. There are documented benefits.
I'll warn you, Mark, this is a groaner, Mark, from Stephen again. He thinks those questions should be weeded out. Okay? So Shirley would like to know, where can we find the recorded sessions on the roundtable?
Okay, probably the best place to find them, because this is universally true for subscribers and non-subscribers, is go to YouTube. Go to YouTube and basically just search. If you go to YouTube and you look for, and Ken, do you remember, do we put the space in it?
I think it's all one word, Mark.
I would try Manifest Investing Roundtable. I should know the answer, but we're saying one word. And then, for example, CVS, to see, when we may have talked about CVS, and that will actually lead you to, in this case, the November 2012 is where I presented CVS as part of the roundtable. So again, if you go to YouTube and you just simply enter something like Manifest Investing Roundtable, you can go straight to the ticker if you want to pursue a particular stock or some of them.
And then if you're familiar with YouTube, you can sign up for the Manifest Investing channel, and then that will put all of the roundtables in one place for you when you log on.
Yeah, when you actually click on it, you can see, when you click on the Manifest Investing channel, you can see a number of sessions. In fact, if my screen was a little bit bigger, you would see like 40 of them available to choose from.
Faith just told us exactly the same thing on the questions there. Thanks, Faith. Sharon would like to know, she's looking for a portfolio management program that compares her portfolio to the market. What are your favorites? Sharon, my favorite is from Quant9, that's Q-U-A-N-T, and then the Roman numeral 9, IX, software. And it's called Investment Account Manager. My wife and I have been using this piece of software probably for more than 15 years now, and we're extremely happy with all of the functionality that it deals with. We're especially happy with the prompt service that we get when we have a question, and our accountant is just ecstatic over the quality of the reports that we can write when tax time comes around. Mark, do you have any program that you use, or Cy, do you have a program?
Well, I would just second the Quant 9. We work with Matt Wilms all the time. Many of you will remember Matt from his NAIC Better Investing days. They just came out with a new and enhanced version of the program with greater data and some more bells and whistles and stuff. I would just say take a look. Send us a note if you are curious about it. You can see here that he does offer a free 30-day trial version. We do use this with some of our asset management efforts also.
Yeah, I'll tell you that my wife was so impressed with it when we first got it that she took the time to go back and key in our entire stock purchasing history so that she has records now that go back for every single stock we've ever owned, and some of them we've owned since we began investing in stocks, so we have very complete records. It'll allow you to do historical. It'll allow you to start today, from today on. It just has all kinds of functionality. Here's a good softball for either one of you. Jaya would like to know, what's your outlook on the current market run-up?
I guess I don't have an outlook. I think there's a lot of exuberance.
May come down.
Yeah, it could go either way. Hey, I wrote an article a few months ago that took a look at the Goldman Sachs. This is from a couple years ago. Their 40 highest conviction stocks and their 40 lowest. In fact, stocks that they would short. And 1 year later, the 40 worst outperformed the 40 best. And I'm not saying this to pick on Goldman Sachs. I'm just saying for the next year, I don't know anybody that calls the market over a short period of a year very well. I will say that I do think we see some gurgling of expectation that of a strengthening economy, a continuing and strengthening economy where profitability and growth might actually get bolstered a little bit here in the next time horizon.
Yeah. I mean, you can look at all sorts of numbers and come to all sorts of conclusions. We're again a relatively aged bull market. You're approaching the 8th anniversary of it next spring. So you're again getting to an old bull. The MyPar at 5.5 and got as low as 5.1, as Ken was mentioning earlier, is extremely low historically. But remember that MyPar is driven by analyst expectations, and what Mark was just saying, if there's some profitability and some growth trends out there, you're going to see the expectations increase, which will push the MyPar back up. So those are two bearish indicators perhaps. Something that I just noticed it was very interesting about the calendar year 2016 that we're currently in. The Russell 2000, relatively smaller stocks, far outperformed so far year to date both the S&P 500 and, for what it's worth, the Dow, which is quite unusual for a late bull market. That's usually what you see in an earlier bull. And so I'm wondering if the market is telling us a little bit about what Mark was just saying, that there's some growth out there. Remember, this has been an odd recovery. It was a very slow recovery back in 2009, 2010, 2011 in many sectors. And we won't get into all of the political hoorah, but you've heard a lot of that over the last 8 years, and you're seeing strengthening, and so all of that seems to indicate to me that this may be it may have been a flatter recovery relative to history, but it may be more sustained.
I left Jaya's question for the end because I think it illustrates the point that the three of us, and I don't mean to speak for Mark or for Cy, but I think that the three of us agree that none of us have a crystal ball, and that we don't know when the market's going to go up, and we don't know when it's go down, and that's why the three of us are pretty well sold on the basic philosophy from Better Investing, which says you should be investing on a regular basis.
Exactly.
Since you can't read the tea leaves, you just should stay in the market and do things on a nice, steady schedule. And that might not give you dramatic ups and downs, but it should give you moderate movement in the right direction if you stick with it. One last question, then I had the board cleared then. This one's from Stephen. He says he owns OII, and they had to sell it at the last meeting. They sold it on a capital gain issue, and they took a loss on it. They still feel it's a good company. Do we have any thoughts? Stephen, I happen to own OII. This is Oceaneering International is the name of the company. And I've just put my oil stocks off into my dead money pile for the moment. I'm not getting rid of them, but I'm not trying to analyze them until I feel that oil has bottomed and is beginning to move towards a profit again. Unfortunately, I have some pretty decent losses in OII, but I also don't need to capture those losses in this particular tax year, so that's where I am. Mark, I know OII still carries a pretty high quality rating, doesn't it?
It's definitely in the good range, but it has stumbled from its exemplary levels of quality. It'll be interesting to see if it begins to turn. That's part of that discussion we had on Drillquip of with a lot of the oil and energy field stocks to see what the next 3 to 6 months hold, because again, I'll go back to using Hugh McManus as an example. He was talking about Bank of America when none of us could stand to even look at it. And his whole premise, it all revolves around size, words about the difference between temporary challenges and terminal challenges. If you really believe they're temporary, and in Hugh's case with Bank of America, he says, this is one of the biggest banks in America. I think they're going to survive in some sustainable form. And frankly, he said he couldn't keep his hands off of it at $4 a share. And it's now up to 20. That same argument could hold true for some of the companies in this line of work. Your Schlumbergers, perhaps Oceaneering fits that bill. They've taken a real fundamental hit. Will they come out and recover? I did notice the Goldman Sachs upgraded some of the fracking companies today. So there are expectations that there will be improvement in that economy, and some of these companies are going to benefit greatly from that. So again, if you can find sustainable, not terminal situations, and believe it or not, even some of the coal companies fit that description. If you look at what some of the coal companies have done here over the last 6 to 9 months, it's actually pretty amazing. There's not very many of them left. But the ones who did survive are just going gangbusters. And that same argument can hold true for some of the exceptional, oil services companies. And I think Oceaneering certainly is in that field of study.
Mark, it looks like I've cleared all the questions from the question box, so I want to wish...
Cake.
Pardon?
I'm going to go hunt for some birthday cake.
Okay, and I want to wish you and Cy a Merry Christmas, because it'll be after Christmas, I think, when we do our next roundtable. Thank you to all the folks that attended this evening, and we hope to see you in December. Good stock hunting, everybody, and good night.
Thanks, Ken.
Good night, everyone, and Merry Christmas.